Hey everyone, in this video I'm going to compare two interesting growth stocks and answer which one I think is the better buy today. The two stocks I'm going to compare are DraftKings, the online gaming company, and Chewy, the e-commerce pet retailer. I'm going to answer which one I think is the better buy. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The first metric I'm going to compare these two on is revenue. And looking back, let's say to 2019, looking at trailing 12-month revenue, you can see they've both demonstrated solid growth. Chewy's increased their revenue from a little over 3 billion all the way up to 11 billion in the most recent trailing 12-month period, while DraftKings, starting from scratch, has built itself up to 3.665 billion in trailing 12-month revenue. Remember, DraftKings is an online gaming company, so it has to get approval with each state it wants to gain action in. So it can't just say we're available in California, for instance. It needs to get approval first from the state to gain access to the state. And then that usually comes with deals like shares of revenue for tax purposes and so on, right? It's complicated. Gaming companies have those issues, but they've done a good job in gaining access to these states for sports betting, right? They're available in roughly 20 states now with sports betting. With iGaming, it's been a little bit slower because there's more competition with local casinos, right? You've seen local casinos in several states where they have gaming. You can go drive about an hour away and you can find a local casino there. So they're more hesitant to give DraftKings access to iGaming. But there's limited sports gambling available in localized districts, and so they're more willing to allow sports gambling on DraftKings because that takes away from illegal black market activity. And so states are more willing to do that, bring it into the real world, the real economy that can be taxed. And so more tax revenue, states always love more tax revenue, right? That's more money that politicians can spend, and they love to spend money, right? So that's been in favor for DraftKings, and they've been gaining traction. Still, that's going to be a difficult going, especially now that the ones that they were more likely to sign on have already come on board. There's other states that are going to be incredibly difficult. For instance, California. DraftKings tried to get into California in 2022 with the ballot initiative. That failed miserably. That failed miserably. There was heavy resistance to DraftKings coming into California because there's so much local gaming interest already in the state. You've got card rooms, you've got horse racing tracks, you've got existing casinos like you drive a couple of hours away, there's casinos at Indian reservations, and so there's a strong gaming presence already in California that resisted strongly to DraftKings and other online operators trying to get into the state. So those forces will make it challenging for DraftKings going forward. Meanwhile, Chewy benefited significantly during the pandemic when people were hesitating to leave their home to go shopping for things, and Chewy gained millions of customers. Now, some of that trend is reversing, and what most troubled me about Chewy was that people that adopted pets during the pandemic started returning them in large numbers. That was really concerning to me. I was under the impression that when you get a pet, you're going to keep it for several years. You're not going to take it back as if it was some item, clothing item that you bought and you brought home and you tried it on and it didn't fit and you just take it back, right? But I saw a lot of that with Chewy, and that's been a little bit troubling. Still, despite that trend, Chewy has done a good job in defining its niche online market and gaining traction, right? You might say, why would anybody shop at Chewy for things when you could go to Amazon and get the same things? And Chewy has done a good job with explaining their customer value proposition to pet parents, and they've gained traction and they've gained a loyal following, and that's been working really well for Chewy. Additionally, they've both demonstrated operating profit margin increases, or what I like to call economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand why that's important, you can see Chewy has increased its operating profit margin from negative all the way up to 0.11%. And DraftKings has seen an even more pronounced improvement, although it's still negative 21.53%. It's jumped from the bottoms of negative 150%. Longer term, I think DraftKings has better profit margin capability because it's an online business, digital, and it doesn't deal with expensive things like Chewy in fulfillment and shipping and handling. And so Chewy would be lucky if it can achieve an operating profit margin at maturity of 10%, while DraftKings, I think, has potential to exceed 20% in operating profit margin in the long run. They're both far away from that, but that's their potential. Similarly, with cash flow from operations, Chewy has demonstrated nice growth in this metric from being flat all the way up to 4.43%, and DraftKings from negative 50% all the way up to negative 0.05%. They've both made excellent progress, with DraftKings making more pronounced progress. I also want you to understand why the average diluted shares outstanding is important. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. Okay, so now that you've got an idea, you can see that DraftKings is diluting shareholders much more significantly, growing from around 170 million shares outstanding all the way up to 468 million shares outstanding, while Chewy has grown from about 400 million shares outstanding to 430 million. They both diluted shareholders, but DraftKings did it more pronouncedly. And finally, I wanted to look at valuation. And this metric, I chose to use the forward PE ratio. And Chewy is significantly cheaper than DraftKings, trading at a forward PE of 19.95 compared to DraftKings, which is trading at a forward PE of 35.43. They both had their pros and cons, as we saw in the video. Overall, I don't think DraftKings deserves this much of a premium valuation over Chewy right now, especially because Chewy is outperforming DraftKings in a number of critical metrics. Although longer term, I think DraftKings has better profit margin capability. I think the revenue capability is better for Chewy as it's operating in a larger market. So for all of these reasons and the lower valuation, if I had to pick today, I would say Chewy is the better growth stock to buy. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.